Hey there, everybody. Charlie Jewett from the Renovating Retirement Movement and the Renovating Retirement Podcast, which you can find at renovatingretirement.com. And what I want to do in this training is talk about cash flow banking for real estate investors. Now, real estate investors are different. I've got all kinds of strategies, 113 podcasts or whatever, for people that want to retire. People that want to maximize how much interest they're earning, how much income they have at retirement, lowering their taxes, all of that. And real estate investors, of course, need to retire someday as well. However, while you're working before retirement, pre-retirement, or maybe even in retirement as you hold rental properties or things like that, real estate investors are a little bit different because one, they may have a lot more cash flow coming in that they need to decide, what do I do with this? Some people that are investing on terms might make $50,000, $75,000 per deal, putting none of their own money in. If you have a really high a lot of rental properties, you may have a ton of cash flow. I had people call me up for my podcast and say, I've got $42,000 a month coming in from rent. I don't need to live on it. I'm living off my job. What do I do with this money? Well, that's a lot of cash flow. You need to make some decisions on it. But more importantly, things like down payments. Should you ever put any of your own money down on property as a down payment? No, I understand. I'm a real estate investor. I understand that sometimes the deal requires that. However, it does not have to be your own money. I know banks are not lending, 100% financing on rental properties anymore, but I'm going to show you how to get around that, how to own your own bank and do that so you don't have to use your own money. But real estate investors are different, and that's what prompted me to want to make this training specific to just people that are in the real estate investment hobby, business, industry, addiction, whatever you want to call it, right? So let's jump into it. Cash flow banking for real estate investors. Now we're going to do a couple of things. Okay, so there's me several years ago. I look a little bit older, got a few more wrinkles, a few more gray hair. But what I do in the world is help people make money, help people avoid scams, avoid the bad guys in the industry. If you just pick one of the big, Edward Morgan Lynch places to put money, if somebody just sticks you inside of mutual funds or you listen to the big pundits that write books, you're not going to get the best advice. The truth will set you free, but the truth is very hard to find in this industry. So we're going to go ahead and jump into some of these tools. I provide all kinds of tools for people to find amazing information. You can go to jewettwealth.com or renovatingretirement.com. But let's jump into this. Cash flow banking for real estate investors. We're going to talk about a couple things up front just for review. Home equity planning. I didn't know what home equity planning was until 2005. I'd never heard of it. The only home equity planning I ever heard of was pay off your mortgage. Just don't have debt. But as it turns out, just like everything else I've studied, there's a much more intelligent way to handle things than what's being told to the general public or what's just popular. So I've spent the last 14 years perfecting and optimizing these home equity planning strategies. So I'm going to talk a little bit about that. Cash flow banking, sometimes called infinite banking or be your own banker. Buckets, creating a bucket for tax-free retirement income. There's all these different names for it, but basically the short version of this is using a type of life insurance where we don't even care about the life insurance, using a life insurance policy with a really small death benefit to store a ton of cash inside of it because it doesn't go down. You don't lose money. It earns an incredibly fair rate of return, especially if set up properly. And it has favorable terms where when you need the money, you can get it out of it, use it, and then put it back. And none of your money ever stops working. You never have a plague. If you have 100,000 sheep, they all keep having babies. Even if you take 20,000 of them and you borrow them for a while, there's still 100,000 having babies. So we'll talk a little bit about that. And then I'm going to point you to a bunch of educational resources where if you like what you hear or you want to learn more, you can go do some digging in the comfort of your own home. So home equity planning. What the heck is home equity planning, or what I call HEP? Again, since the Depression, basically the model, the beliefs in our country has been mortgages are bad, paying interest is bad. I've even heard people go so far as to say there's two types of people in the world, those who pay interest and those who earn interest, and that's a little bit narrow. There's a third type of person in the world, including the biggest financial institutions on the planet, banks and insurance companies, the most profitable, biggest financial institutions. Insurance companies, we've never lost a single one of them, not even in the Depression. We lost 5,000 banks in the Depression and no insurance companies. That's how strong they are. And what do they do for a living? Basically, they get into debt. So there's not two types of people in the world, those who pay interest and those who earn interest. There's a third type of person in the world, the most intelligent, the most wise, the most wealthy, those who pay low interest to earn higher interest, which we'll talk about. Banks and insurance companies make 50 to 100% rate of return regularly. That's why they pay us commissions in the financial services industry. That's why they pay commissions to get them into debt, to get you to lend them money by buying CDs, annuities, life insurance policies, things like that. Banks and insurance companies make 50 to 100% rate of return by not paying off their debts or their liabilities. So why should we be doing that? Someone comes along, I don't care how popular it is, somebody comes along and says, debt is bad. You should not have debt. You don't have to buy that hook, line, and sinker. There's some rules to tell you whether debt is good debt or bad debt, and I'm going to show that to you. Arbitrage. That word is so important. It'll change everything in your life. Arbitrage is the wholesale retail of the financial world. Do you feel like we've proven, as a people, as a society, as a world, let's say, do you feel like we've proven that buying things low from a manufacturer, marking them up, and selling them in stores like Starbucks or Target or Walmart, buy low, sell high, buy wholesale, sell retail. Do you feel like we've proven as a people group that that works, that that's a sound financial strategy? The answer is an abounding yes. Well, the sister to that is arbitrage. Borrow low, invest high. Borrow at 3, invest at 5. Borrow at 4, make 5 or 6. It's just as proven, if not more. It may go back even further. It's just not as popular or not as well known, and there's some anti-messages out there like debt is bad, you should never have mortgages, yada, 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 yada. There's two types of people in the world, all that kinds of stuff. So let's take a look at this. I'm going to look at a vital signs report. There's going to be a lot of outside information that I want to show you. Oh, I'm going to do it this way. There's going to be some outside information that I need to show you as we go through this. Let's pick any insurance company in the country. Okay, I had 40 or 50 I could pick from. Let's pick Nationwide. Why did I pick Nationwide? Because it's at least somebody you've probably heard of. A lot of the big insurance companies, American Equity, Security Benefit, Allianz, North American, you just are never going to have heard of them because they don't sell car insurance using cartoon characters during the Super Bowl. They're sitting in the backgrounds doing an amazing job selling to retirees through agents, not television. But Nationwide happens to do both. They're on television and they sell through agents, so let's just pick one that you guys know about. Now, first thing to understand about this report, because what I want to show you is that there is no insurance company on the planet or a bank that believes that you should be debt-free or that believes that debt is bad. None. Not a single insurance company anywhere that believes debt is bad. So just take that to heart, and I'm going to show it to you. Now, these are in billions. I wish they'd change the report. There's certainly room for 3 more zeros. I don't know why they're trying to save room, but this particular company that offers these reports, which is kind of the standard, we all use it in the financial services industry, they don't provide the 3 zeros, so this is in billions. These guys, this insurance company, Nationwide, has of your money, of client money, total assets of $128 billion, $128.5 billion. If everybody called on the same day and wanted to cancel, they said, give me my money back. That's kind of like everybody going to a bank saying, give me my money back, which is very bad for banks, by the way, if you've ever heard of a run on the banks. Insurance companies don't have this issue. But if everyone canceled on one day, their total liabilities, their debts, ooh, bad word. Or is it? Debts, liabilities and debt is not a bad word if you're paying less than you're earning. So if they had to pay all their debts on one day, it's $124 billion. It's just helpful to go down to this surplus line. Say they have $4.6 billion more dollars than they need to pay all of their debts today. Now pick someone in the industry, Dave Ramsey, Susie Orman, pick some popular pundit who's writing stuff to the average American who's not even disciplined enough to stop charging up things on their credit cards, right? So they're just running up the cards, just an undisciplined person. That person wants to sell books, so they say all kinds of crazy things. But take somebody like that who says debts are bad. You should never have debt. You should always pay off your mortgage. And put it in this, look at this and say, what's wrong with this insurance company? Is Nationwide stupid? Have they never read Susie Orman's books? Have they never read Dave Ramsey's books? Have they never even come across this idea that debt is bad? What is wrong with these people? And what you'll find is if you talk to somebody from the insurance companies, they're just going to turn around and say, what is wrong with you? Why would we ever take $124 billion of the $128 billion we have and pay it off if those liabilities cost us 4% and up here we're making 5%? Or if these cost 3.5% and up here we're making 4.5%, and you can actually see what they're making, 4.69 over 5 years. Folks, all that's going on here, and I'm going to show you more about this later, but all that's going on is that every single insurance company and bank in the country, when they pay us to park money with them, they pay us less than they earn when they go put it into bonds or into mortgages or into car loans. That's called arbitrage. You could look at certain banks, and on one window, you could stand in front of the bank. One window will say CDs 2%, car loans 4%. It's the same money. They're paying us 2% to rent the money, and they're earning 4%. Well, what's the rate of return? That's 100% rate of return. For every $100,000, they pay 2%, $2,000 a year. They make 4%, $4,000 a year. They're paying $2,000 to make $4,000. They're making 100% rate of return. That is why debt is not bad. Debt that costs you more than your assets are earning may not be a wise choice, and that's what you want to pay attention to, is how much are your assets earning. Okay? Now the next point here, I'll flash it up really quickly before I drop back out of the presentation. Right here, we're going to go to watchcharlie.com. I'm going to show you where to find a ton of videos on what I'm teaching, but certainly the arbitrage video and the home equity planning video. Okay? Drop back out. Let's go to any browser. You guys just type watchcharlie.com. Now, my suggestion when you get here to my channel is first you click on videos. Boom. That's going to populate all of the videos. Now, a lot of what shows up here is my podcast. The service I use to post my podcast posts sort of a video on my YouTube channel, but it's not really a video. It's just audio with a picture. But just scroll down. Come down here. And the most important thing to find right here is the only time I ever wear a suit. The only one where you see me wearing a suit. I work in San Diego and Hawaii. I'm usually in flip-flops and an aloha shirt. So here I am, 50 minutes. This is me in Utah, teaching a bunch of conservative and people in Utah why never to pay off your mortgage and why possibly to refinance your home, take all the money out, and pay 4.5 to put it somewhere where it's making 6. But this home equity planning video for sure you'd want to watch. Now there's an arbitrage video. I don't know if it's going to show up because it may have been a long time ago, but I'll just scroll down here. Let's see here. It's not showing up, so you could just go like this. You could just go arbitrage Charlie Jewett. In case accounts, there it is. Arbitrage explained. Do what the banks do, not what they say to do. That video right there is going to be talking about arbitrage just like I'm showing you here. All right? So those are some educational resources you can go take a look at to see why borrowing low and investing high just makes sense. All right? Now, you don't have to get really complicated with this. If you have $100,000 making 6%, which, guys, stockbrokers can't show you this. Stockbrokers, what they do for a living, or mutual fund salesmen, the Edward Morgan Lynch guys, what they do for a living is risk. They say we're going to go try to make 6, 7, or 8%, but it might go down. They can't show you how to make 6%. Everything changes in your life when someone like me comes along and shows you how you can make 5, 6, or 7 with no losses. It changes everything. If you have $100,000 making 6%, $6,000 a year, and you have debt that's costing you 4.5% or $4,500 a year, what should you do? Should you give up $6,000 to save $4,500? No, because it costs you $1,500 a year. It's very simple. How much are your assets making? How much is your debt costing? That is the only thing that determines whether it's good debt or bad debt, or whether you should pay it off. Matter of fact, if you can borrow at 4.5% and put it somewhere making 6%, I would borrow billions and billions and billions of dollars if I could. So what should you do with a $100,000 asset in this situation? Leave it alone. Let it make $6,000. Take $4,500 of it, pay your debt, keep the $1,500. That's what all, I'm not kidding, that's what all wealthy people that I've studied do. Wealthy individuals do not believe you should pay off your mortgage or that debt is bad. The wealthier they get, the less they believe that debt and liabilities are bad. So what should you do with extra money that comes into your life? If you're getting an extra $1,000 a month, or you get a tax return at the end of the year, you get an inheritance, and you have debt that's costing 4.5%, or you have assets that are making 6%, should you put into the assets or pay down the debt? It's very easy. Whichever one is better for you, whichever one's more profitable. If you're making 4.5% and your debt costs 6%, pay down your debt. But if you're making 6% and your debt costs 4.5%, build up your assets. It's very, very simple. Way more simple than you'd imagine. Now, let's talk about banking or bucket strategies. This has come in a lot of different names. Probably first was something called Be Your Own Banker, right? Nelson Nash, I believe it was, many decades ago. Then Douglas Andrews came out with Misfortune and Misfortune 101 in the early 2000s, showing people how to borrow money from your home, put it into insurance contracts, and make an arbitrage, keep the home safe from losses. All the stuff we've seen, like Hurricane Katrina, the Jersey Shore, Houston, the fires in California. Now we have the lava flow and the hurricanes in Hawaii. Anything that would destroy your home, having equity inside of that home can be a problem. But keeping money outside of the home, especially if it's profitable, if you're borrowing at 4.5% and making 6%, is awesome. But it's also safer for those sort of natural disasters type stuff. Now, the history of this is kind of interesting. This used to be available only to the ultra wealthy. So I learned this in 2005 from Douglas Andrews of Misfortune. But prior to that, it was really only wealthy people that understood this. And I can tell you a story. I talked to a guy that owned a couple of skyscrapers in downtown LA, and if you can imagine what a skyscraper in LA costs or what it's worth as a real estate investor, this is a very wealthy man. I remember talking to him in the early 2000s about wanting to pay cash for a home. And he literally said to me, why would you ever pay cash for a home when you can borrow money so cheap and keep your money working for yourself? And I didn't even get it. Honestly, I do this for a living now, and I didn't get it when he first said it. But he was really alluding to the same thing that I'm teaching, which is that the fact that a bunch of people during the Depression lost their homes because the old mortgages had clauses inside of them that said the bank could ask for the money back for no reason. Even if you were making your payment, they could ask for the money back and just give you 90 days. Today, that's not true. If you're making your payment, the bank can't ask for the money back. So everything's changed. The fact that it became traditional for people to hate mortgages and want to get rid of them doesn't change the math. It doesn't create any sort of new truth. It doesn't change the reality that if you have $100,000 making $6,000 a year and you have debt that's costing $4,500 a year, it doesn't change the truth that you're still pocketing $1,500 and keeping your money safe from depreciation and loss of home. It was just a very emotional thing that happened in our country. So the history of hating debt and hating mortgages has to do with the Depression and people losing homes under old terms that don't even exist anymore. It was a term where the bank had a right to call the loan due within 90 days for no reason. We don't have that anymore. As long as you make your payment, the bank's not going to take your home, so we're good. So changes over time to these strategies. Some things have changed in the sense that the most popular author, I would think, my opinion, right? I talk a lot about truth, but I'm going to give you my opinion and I'll tell you what it is. The most popular author on this is Douglas Andrews with his books Misfortune and Misfortune 101. However, they were written in the early 2000s when houses were skyrocketing, just appreciating like crazy. We had no down payment mortgages, so 100% financing for anybody who could breathe. everybody was making money, so you could refinance every 2, 3, 4 years. We had negative amortization loans, and we had interest-only loans. And everything he wrote was true. However, the world of mortgages and appreciation changed a little bit. So I saw probably 80% of the people that taught these strategies drop off in 2008, 2009 when the mortgage industry stopped. But nothing changes nothing changes about the truth. It's just if you have equity that you can access, or if you have extra money that you have to decide whether to put into investments or into equity, you need to know how to make these decisions. Now, this has gotten a lot of bad press because there's people out there that did it poorly, and I understand that. But bad press really doesn't mean anything. You can't really throw the baby out with the bathwater. So there's people that say, oh, life insurance is too expensive. You shouldn't use it as a cash accumulation vehicle. Misfortune is terrible. Douglas Andrews a bad guy. Don't ever listen to anybody tell you to take the equity. Blah, 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 right? Listen, try to answer this question. Do musicians make good money? It's the same as saying, should you use home equity planning strategies? Well, the do musicians make good money should be followed by, I don't know, which musician? If we say, do most musicians, most people that can play a musical instrument make killer money above the average income for the area, the answer is no. Most of them are probably sitting in a coffee shop or a restaurant or a bar playing for much less than they need and less than they're worth. But do musicians make good money? You can't say no, because Taylor Swift and Elton John and Lady Gaga are doing okay, right? So you have to say, which musician are you talking about? Okay, you shouldn't use home equity planning strategies. Which home equity planning strategy, and who's the you? Who are we talking to? It all depends on the person. It depends on your situation and which strategy you're talking about. Now, the other thing about these banking or bucket strategies, all of them have been based on life insurance. Historically, life insurance is not exciting. You don't need life insurance. Life insurance is it's an expense in your life, something you don't want to pay for, in case you die, to cover your loved ones. And it's an act of love, and that's fine. But for most people, it's just an expense. You buy it, big death benefit, really small premium. From the 80s, with a guy named E.F. Hutton, we learned this strategy of maximum funding. How do you buy a minimum death benefit, put a ton of money inside of it, because it grows completely tax-free? And all this personal banking, infinite banking, be your own banker, cash flow banking for real estate investors, all of it came from tweaking insurance policies to work on your behalf, where it's not an expensive, you have to pay for life insurance thing, but just enough life insurance to satisfy the IRS, and you put a bunch of cash in and it grows like crazy. And the way to understand this is to pick something you already understand, which is what analogies are good for. There's a car called a Crown Victoria. It's not a super sexy car off the lot. It's just a normal car. But many police departments use it, but they soup it up. If you ever get into a police car, which I hope you don't ever have to, usually means bad news. But if you ever get into a police car, you'll notice they have very different insides than we're used to, right? A lot more computers, a lot more gadgets and stuff like that. Well, under the hood, in the engine it's also been altered and changed. So you take something that exists in a form that's good, you soup it up, you do aftermarket work on it, you make it amazing, super fast, super powerful, all that. That's what works. So anything you read on Google or the internet about insurance or index universal life or be your own banker or cash value life insurance, anything you read, there's going to be a bunch of negative, because they're talking about the policies that haven't been built properly, that aren't souped up. This is an industry where it has to be built properly, and when it is, it's a cop car, and it does amazing, amazing things. Now, why advisors don't do this, why have you never heard of this? Probably the most common thing I've heard in 14 years is, well, if it's that good, why isn't everybody doing it? Number one, most important thing for you to understand, why have you never heard of this? It doesn't pay well. Frankly, it does not pay well. The only way to make this work for you, the one buying the policy, is to reduce, to make very small, the life insurance death benefit. Life insurance agents get paid a commission on the size of the death benefit. Those two things don't line up well for you hearing about this. Agents must minimize the commission down to the legal minimum, or else they choose to hurt you and not do what's best for you. So what do we have in the industry? A bunch of agents who say, screw that, there's no way I'm going to work with a strategy that doesn't pay very well, and they just don't offer it. Agents that say, screw that, there's no way I'm offering it unless I get paid well, so they offer you a bunch of policies that aren't designed properly and rip you off. And then you have my group. I don't know another group doing it except for guys I've trained in Chicago and Arizona. You have people like me that say, you know what, do what's right every single time, earn the money in other business and referrals and goodwill, and it's a mission anyway. We're trying to change the world. It's not about the money. So the reason you haven't heard of this is it just frankly doesn't pay very well. All right, some educational materials on home equity planning. I showed you the watchcharlie.com, which goes to my YouTube. You could also go to listentocharlie.com. It's going to point you to my podcast episodes, and you can listen to 74 through 79. Episodes 74 through 79 are all on home equity planning. Just episode after episode after episode where I dig into it. Home equity is not liquid. Home equity is not safe. Home equity doesn't earn a rate of return. Home equity doesn't help you on your tax deductions. Where do you put your home equity if it's not going to be inside your house? And this, guys, if you have a portfolio of rental properties and your goal in the past was to pay them all off, own them free and clear, and just have rents coming in, which you may or may not have realized there are going to be 100% taxable rents. Forget depreciation right now. There's no mortgages to offset those rents. If that was your goal, if that's what you thought was wise and safe, these materials are going to completely change your worldview and change your mind. Owning 40 properties free and clear, in my opinion, would be paramount to failure. There's a much better way to do that where you get more cash flow, more tax deductions, more safety, everything good. Long life, short life, rough life, sick life, next life, everything could possibly happen to you. It's better this other way. So go ahead and go and listen. Learnfromcharlie.com. You can go look at my books. The 2 Ways to Be Debt Free is a free book right now. So you can go look at the 2 Ways to Be Debt Free book, download it for free, and read it. It's 27 pages, I think, on this idea of arbitrage and how to use mortgages to create arbitrage, borrowing on your home, making small down payments, that kind of stuff. All right, let's move on, okay? Charlie's Tax Free. If you go to charliestaxfree.com, there's a 1-hour video just on the life insurance tool. How do you use cash value life insurance? How do you take a Crown Victoria, turn it into a police car? How do you make it crank? And when it cranks, it's making 6 to 10% per year tax-free with no losses. Listen to Charlie.com is the podcast. You can listen to episode 26, 27, 43, 58, 91. All of those are on that infinite banking or tax-free growth and life insurance bucket strategies. As far as books, I've mentioned Misfortune 101, which is not free. You probably have to pay $7, $12, or whatever it is. But Misfortune 101, chapters 9 through 11 are stellar. They're the Bible on this kind of stuff. So if you want to learn from the person who taught me, you can go take a peek at that. Now I want to switch gears. I don't want to talk about review. I don't want to talk about educational materials. I want to give you hard-hitting 4 ideas if you're a real estate investor, how to apply these strategies and where to get more information. Now, I don't know what kind of real estate investor you are because this education is going to go out to the whole country. It's going to go out to everybody. But I've done this myself. I'm involved with a lot of real estate investors, Joe Fairless, the old dog from Old Dogs REI Network, Chris Prefontaine, all kinds of people in my life. The guy that ran seminars for Robert Allen is now coming on to run seminars for me. A bunch of real estate investors in my life. And here's 4 ideas that I think are going to be really helpful if you fall into one of these categories. 1, if you use your own money for down payments. I have done this. Okay, I had 15 properties in a period of 9 years. I remember having to make down payments because these were rental properties and I already owned a bunch. They didn't want to do 100% financing. If you have to make down payments, I want to teach you the best way to do that, where to get money that's not your own to keep your money working for you. Now, increasing your cash flow using these arbitrage strategies I talked about. And what I say is that 2 incomes and 1 expense are better than 1 income and no expense. What's the 1 income, no expense? The old goal. Pay off the mortgage and just have rent coming in. There's some issues with that. All of your money's sitting inside of the home, not working for you, and the rent then becomes completely taxable. If you do have a mortgage and keep that equity outside of the home earning interest, that's a second income. It's almost like having two rents. And you say, well, where, but I also have an expense. Expenses aren't bad. That's why every company has employees. They pay them $60,000 a year in hopes that that employee makes them $90,000 to $120,000 a year. There's nothing wrong with expenses. It's what they do for you. So I want to talk to you guys who have had a desire to pay off properties because you think it's going to increase your cash flow. There's a better way to cash flow on all rentals. If you don't use any of your own money, so if you're investing on terms like Chris Prefontaine teaches at the Smart Real Estate Coach, if you don't need to put your own money in, if it's all on terms and you've got 3 paydays and you're just cranking dollars, you're just getting paid every time every time you go into contract, you get paid. You get paid every month when they're paying you on the rent, and then you get paid every time a house sells, and you just have payday. Yes, I want you to take what you need to live on, but all that extra money, where should you put that to get the best bang for your buck? For your growth, your investment. You're growing your net worth, you're compounding, having that money make babies and provide for you in retirement if there comes a time where you don't want to do real estate deals anymore. And then I'm going to teach you probably the most powerful and most exciting part of this video is how do you use safe leverage? Exactly what mortgages are. When you borrow from a company, from a bank, to live in a home you can't afford and make your life amazing, way better than it could be without that. That's a perfect analogy for what exists in the retirement planning world. Banks will lend you money so you can have an incredible retirement, a retirement you never even dreamed of, and all they want is their interest. Just like a mortgage, it's worth it every single time. Let's jump in. Down payments. This is for investors who use their own money. Did you know? Were you aware, or has anybody ever told you that all properties use 100% financing? Every property is 100% financed. You go, what? That's not true. No, it's not. I only did 60%. I only did 70%. I only did 80%. But every single property in the world is 100% financed. Imagine you put 25% down and you borrowed 75% from a bank. Kind of standard for rental properties, right? You're doing a 75% loan to value. And who comes up with the 25%? If you want that property, you do. You got to make a down payment, right? Where did the 25% come from? Who's providing it? Who's financing the 25% down payment? The question is, because you're financing it, you realize that. If you take, say there's a property, I know it's expensive, but it's easy math for me on the fly. Property worth $1 million, you put $250,000 down, you borrow $750,000. Where did the $250,000 come from? It may have already been in investments, or if it was sitting in your bank from the sale of another property, where could it go if you didn't put it into the property? It could go into other investments. The question is, what was it earning, or what could it have earned if you didn't stick it inside of that home? Because you don't get a tax deduction for those lost earnings, and that's called an opportunity cost. Okay? Now, I think I want to jump to a calculator right now. Yep, I want to jump to a calculator right now. Let's go here. Actually, back here, boom, boom, and say future value calculator. Pretend you're buying a house that's $300,000, and you're going to put $75,000 down as a down payment on that home. The way that I've been trained to think, the way that I want you to start thinking, the way that wealthy people think, the way that insurance companies and banks think, nonprofits. What does it cost me? What's the opportunity cost? Forget I lowered my mortgage payment. That's amateur. What does it cost me to put $75,000 down into this home, take it out of investments, or choose not to put it into investments? 6% is easy. I understand you don't know that right now, but when you learn these bucket strategies and index universal life insurance built like a cop car, when you watch my video at watchcharlie.com or charlietaxfree.com, when you watch the 1 hour long video on how to use insurance buckets with minimum death benefit, no losses, tax-free growth, some of them have made up to 10% a year over the last 30 years, you're going to see 6% is not a problem. That money could sit and earn 6% compound interest for the next 30 years. Calculate, right? I already did this for you. But what's it cost over the term of the mortgage? $430,000. You would have an account of $430,000 if you left that money sitting, compounding at 6%. Losing that, taking the money out or not putting it in, losing all of that, even though it's a loss, that's called an opportunity cost, you cannot deduct that. You may not write that off on your taxes with the IRS. The IRS does not doesn't take into consideration. They don't honor opportunity cost as a tax deductible expense or as a loss. Now, what are you trying to save? I understand some properties don't offer 100% financing on rental properties, or some banks don't, but I'm going to show you how to get around that. What are you saving by not borrowing $75,000 over 30 years at 4.5%? Well, that would cost you $380 and 1 cent. $380 a month and 1 cent. So you're giving up $430,000 over a 30-year period to try to save $380 and 1 cent per month. Well, times 360 payments, that's your 30 years. Total cost, this horrible, horrible thing that just gets, demonized. Mortgages are bad, paying interest is wrong, blah, 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 right? Look how much of it goes to interest and not principal, and blah, blah, barf, barf, barf. Over the 30 years, to borrow that $75,000 at 4.5% would cost you $137,000 basically. Guys, ladies, all day long, I would pay $137,000 to make $430,000. You're not even an investor if you wouldn't do that. Those numbers are stellar. No way I'm giving up $430,000 to save $137,000. There's no way. You're better off with the arbitrage, paying the 4.5% and keeping your money compounding. Okay? So we don't need to do this. There's a better way to do this. Every property is 100% financed because you're either financing it through losing compound interest on every single dollar you put into your properties, and you can't write that off on your taxes. Because I showed you the cost of $380,000 and 1 cent. I'm sorry, $380 a month and 1 cent. I didn't take into consideration what it saves you on taxes. Maybe only costs you $320, $300. I ignored that, and the numbers look good. Is there a better way? Yeah, there's a better way. Borrow the down payment. Do 100% financing. If every property is going to be 100% financing anyway, the traditional bank finances 75 or 80% of it, and then someone finances the second piece, whether it be you through opportunity cost, stopping your money from earning interest, or some other way. Imagine if this existed. If I could provide a bank for you that had the following terms: 100% financing on investment properties, there's no down payment. Or they would finance the down payment. They do second mortgages up to 100%. So a traditional bank does the 75. This bank gives you the 25. Rates are based on Moody's corporate bond rate over the last 50, 60 years. That's about 5 or 6%. Right now, today, it's about 4.3, 4.4%. Call it 5. They'll lend you money at 5% so your money can keep doing its thing. You never have to put any of your own money into anything. The cost of using the money can be written off on your taxes. Ooh, now we're talking. Because if you make a down payment and you lose 5 or 6% by not having it invested somewhere else, you have that opportunity cost, you can't write it off. However, if you pay 5% to do this 100% financing, you can write it off. So maybe it only costs you 3.75 or 4% when you take tax savings into consideration. I like it. No monthly payments on the loan. What? Are you high, Charlie? What? You're used to loans, whether it be a line of credit on a home, borrowing from one real estate property to invest in another, traditional mortgages, personal lines of credit. You're used to lines of credit where you have to service the loan monthly. Even if it's interest only, you still have to pay it. These loans have no monthly payments, period, until you're dead. No balloon payment. The loan can be paid back upon your death. No opportunity cost of using your own money. All of your sheep keep having babies. I love that. I love it. Historically, keep your money making 6 to 7% completely tax-free and don't tie any of it up. Oh, and by the way, just a little side note, you don't have to qualify. Nobody's checking your credit. Nobody's seeing if you qualify on income or property. Are you too extended? It's just a right of a human being. It's just your right to borrow the money at favorable terms for one very important reason, because you own the bank. And this is what I teach. This is what I've been teaching for 14 years. This is what I will never stop teaching. If you own the bank, you're in charge. And the banks that you can own are better banks than you could bank with anywhere else. You want to build your own bank by storing your hard-earned money inside of a life insurance policy that's set up to be a cop car. And then everything I just described to you, let me go back, if it'll let me. Everything on this screen, these are the terms of borrowing against an insurance policy. Now, many of the real estate investors that you're learning from have already done this. Joe Fairless did. Chris Prefontaine did. They've already done this because it's sound and it works. Having your money working for you. I'm going to use a big number again. Having $1 million sitting inside of a life insurance contract, and you find a property you need $100,000. Borrowing $100,000 from the insurance company at these terms, letting your $100,000 continue to compound at 6 or 7% with no opportunity cost, is just better, wiser, much more financially sound than making a down payment and giving up the right to earn money on all of that money that you put as the down payment. So you want to own the bank. Now, let's move on to strategy number 2. Strategy number 1, don't make down payments with your own money. Work with my company. I will show you how to set up your own bank and get those incredibly favorable terms. Keep every dollar in your life working for you. And then borrow from insurance companies to make your down payments, because they will do 100% financing on rental properties, any properties, no qualifying, no monthly payments, incredible terms. If you're going to own property, if you have rentals, if you're trying to cash flow, which is a buzzword in the real estate community, if you're trying to cash flow your properties, I'm telling you 2 incomes and 1 expense are better than 1 income. Here's the traditional way to cash flow a property. You pay off the mortgage, say mortgages are bad. Susie Orman and Dave Ramsey would be mad at me if I didn't do this, so I'm going to pay off my mortgage and be a good boy or a good girl. You pay off your mortgage. And you collect the rent. Nobody's talking about the opportunity cost of all the money you put in. Nobody's talking about how you destroyed all your tax deductions on that property forever, how your rent is now 100% taxable. Nobody's talking about how if the property depreciates or is destroyed, you're going to lose all that money, which you can find out in my videos at watchcharlie.com. Nobody's talking about that. It's just a super oversimplified, ridiculous strategy. Pay off your mortgage, collect the rent, and they call it cash flow. I'm not saying it's not comfortable. I'm not saying it doesn't feel good, but doing crack might feel good. I haven't, but I've heard, right? Drinking feels good. Not exercising feels good. Not cleaning my garage feels good. Not getting out of bed actually feels pretty good. But none of those are good for you either. We're not looking for the feel-good thing that hurts you. We're looking for what should you do if you're disciplined so that you put yourself in the best possible situation. So we have no expenses, or low expense if you have like an HOA or whatever taxes on the property, and just 1 income that's taxable. Pretty bad amateurish plan. I understand until you have another option. I know why you do this, and I think you should do that until you learn another option. But with more knowledge, when you're exposed to a better way, then you might choose something different like I have. The new and improved way to cash flow properties is keep the highest mortgage possible on every property you own. Certainly put as small a down payment as you possibly can when you buy it. Use the strategy I talked about previous to this to not put any of your own money in. Use insurance company money. and get those incredibly favorable terms. But you want to put the highest mortgage possible so you have a tax-deductible expense. Keep your home equity, all of the money that normally would sit inside of a house. Forget whether there's 100% financing or not. If you have a house for $500,000, is $500,000 better off sitting inside of the house, meaning you own it free and clear, or sitting outside of the house, making 6 or 7% compound interest for you? All of that is determined by how much it costs to borrow it. Keep your home equity set aside, earning 5 to 7%, and that's your first income. It's another rent. Folks, all of the equity sitting inside of your house is dead equity. Your house is going to appreciate. Your properties will appreciate whether you have a mortgage or not. The equity inside your home does not add to your appreciation. Appreciation is based on the value of the home, period. Equity inside of the home should only be there if you cannot make more interest than it would cost you to borrow it out or to keep it out. And if you can't, you're working with the wrong financial planning group. I'm telling you, your first income, your first rent, is all the equity and all the compound interest that it's making. Remember that 6%? $75,000 at 6% turns into $430,000 over 30 years. That's your first rent, and most of you are giving that up by sticking all the money inside the house where it can never earn compound interest ever again. You're neutering your money. You really are. You're neutering your money, making sure it cannot have babies and can never compound if you stick it inside of a property. Collecting the same rent you get is the second income. 2 incomes, 1 tax-deductible expense is better than 1 income, no or low expense. Here's an example for you. Say you have a $300,000 home, you do it the traditional way, there's no mortgage, your rent is $2,000 a month or whatever the market rent in your area. I really don't care about the numbers. It's all based on, per property anyway. We look at it. Okay, what's the new way? Well, it's a $300,000 house. You can borrow maybe 75% on it. When you buy it, just do a first mortgage of $225,000. Now, I'm not even talking about my no down payment strategy. I'm ignoring that. I'm saying you actually made a down payment and it's still better. If you use the first strategy, this would be incredible. But even this way, even making a down payment of $75,000 and borrowing $225,000 or keeping that money outside of the home earning interest. So the $225,000 sits outside the home making 6% tax-free. Well, that's making about $13,500 per year or $11.25 per month in interest. That's your first rent, your first income. All the equity you'd normally store in the home, if it's outside the home, it's earning interest. That's another rent. And then you have your rent, what the person pays to live there, $2,000 a month. So your total monthly income is $3,125. Well, you have a mortgage. This $225,000 right here, it's not free. Employees aren't free either, and every company has them. Why do you pay someone $60,000 a year? Because you think you're going to make $90,000 to $120,000 on them. Nothing's free. That doesn't mean expenses are bad. Expenses are incredible. You pay low expenses to earn higher. So why do we pay rent, or why do we pay mortgage interest? I shouldn't use rent. That'll be confusing. Why do we pay interest? I call it renting money. That's why I said that. Why do we pay interest on $225,000 to keep it out and earning interest? Because it's good for you. You'll see. You pay $1,208 a month. Now, some of that is actually principal payback to yourself, which is incredibly powerful. I'm going to ignore that point. So I'm ignoring principal payback. I'm ignoring the fact that the down payment of $75,000 could be done with the be your own banker strategy. I'm completely ignoring all of that and just looking at this straight. Income of $3,125 minus expenses of $1,208 a month. Your total income, $1,917 net income after expenses. Now, you're like, wait a minute, what's this guy even teaching? That's lower than $2,000. Let's go way back here. You're like, look at this, Charlie's such a doofus. The original way was better. The way he says not to do it, I made $2,000. The way he says to do it, I make $1,917. Or are there some things that we might be missing? $1,917 income with a tax deduction of $1,208 plus principal payback. Some of that $1,208 goes into your pocket. That might be better than a straight up fully taxable $2,000. Tax deductions are powerful. $225,000 less of your own money tied up in real estate. So it's out, showing up as net worth, showing up as liquid, showing up for qualifying for other properties or to be used for other properties. Compound interest on the $225,000. That's pretty awesome. Principal payback. You're paying this $1,208. I mentioned you're paying some of it back to yourself. By the way, how powerful is principal payback? Let me just go over here for a second. Remember this? Remember this right here? I said, okay, a $75,000 mortgage at 4.5% costs you $380.01 per month. You do that for 360 months or 30 years. You have paid yourself back, or you've paid a total interest and principal of $137, let's call it, $137,000. But some of that's going to you. Remember this? I said $75,000 at 6% over 30 years turns into $430,000. Watch this. 2.7, 2.3. I'm trying to get this number to be 136 right here. 2.1. Nope. 2. I didn't know it was going to be that low. Yeah, roughly 136, called 2.05, just over 2%. Nope, still too high. Whatever, 2%. So what does this mean here? If you had money, $75,000, making 2.02% because of compound interest, over 30 years, it would turn into $136,000. 2.02. If you borrow money at 4.5%, $75,000 for 30 years at 4.5%, over 30 years, it costs you the same $137,000. I talk a lot about arbitrage and say if your money's making more, if your money's making more than you're going to pay, then you shouldn't use it. But it's actually much, much more serious than that, because amortization, some of that 380 goes to you, right? Show the amortization schedule. Show the schedule. We come down here. In the first payment, $98 goes to you. Later on, it's like $104. You get towards the end of the loan, and 311 of 380 is going to you, because some of it's going back to you. The reality is, if you've got money making 2.02% in your investments, which I can show you how to crush that, you should still be borrowing money at 4.5% and not using your own money. You should not use your own money. You should not kill your sheep. You should not neuter your money. You should not stop your money from earning compound interest so that you can try to save some sort of amortized interest payment. The math doesn't work. And anyone who tells you that it does, or that that's wise, has not done their homework. Do you hear the message? 2 incomes and a mortgage expense. What are the 2 incomes? Rent and all of your home equity that you would have stuck inside the home and had dead money. All of that earning interest, plus the rent your renter's paying, is better for you every single time. Principal payback. Can you get a loan for less than 5%? Because that's what I was using in this example. 5, not even 4.5. Can you earn more than 6? Some of the strategies I teach, some of the insurance policies have made over 10% annually. 95% of the 20-year periods we can measure. And there's like 256 of those periods. So most of the time, almost 100% of the time, they made over 10% compounding annually. Depreciation protection. If you put $75,000 down on a property that's worth $300 and it depreciates 10-20%, whose money's lost? Yours. Everything you put in disappears. Nothing is more at risk than the down payment you make on a real estate property, because if it goes down, if it depreciates, you lose your money first. Protection from loss of the home. If the home is destroyed in a flood, a fire, lava, hurricane, earthquake, you don't want to be fighting some insurance company trying to get the equity that was in the home back or to try to rebuild. I know it shouldn't be like that, but I pay attention. And I'm telling you, there's people all over the country fighting with insurance companies from Hurricane Katrina, trying to get their money to rebuild, and the flood insurance says the wind destroyed their home, and the wind insurance company says no, there's a flood, and blah, 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 blah. They just fight them. All kinds of different benefits for you. Now, third strategy for investors who don't use their own money. You're investing on terms. You don't use any of your own money anyway. You're just doing deals and getting paid. If it's Chris Prefontaine's way, you're getting paid 3 times, right? When you sign the contract every month, and then when you sell the property. How much can you put away for your future? Now, that's up to you. I can help you determine it, but I told you, somebody called me and said, I've got $42,000 a month from rent. Other people call up and say, I've got 2 properties a month I flip. I'm making $50,000 on each one of them. I can give up $50,000 a month and live off the other 50, whatever it is, whatever your number, even if it's $1,000 a month, doesn't matter. It's you understand your cash flow. Whatever money you can put away for your future, we're going to put away. Where should you put your retirement savings? Well, where you should put your retirement savings basically today is 100% based on your view of taxes. Do you think taxes are going to go up or down? I'm going to make this really easy for you. Do you think taxes are going to go up or down? If you say up, you should not be putting money into 401ks and IRAs. You should not be postponing taxes to a later date when you think taxes will be higher. If you think taxes are going to be higher. Now, if you're getting matched in your 401k, that's fine. If you're getting 100% match, that's fine. That video I talk about, watchcharlie.com or taxfreecharlie.com. You can go to the video and see, you'll see all this. But if you're going to be in the same tax bracket, making the same income, or hopefully a higher income, and you think taxes are going to go up, you don't want to use 401ks and IRAs. You want to use tax-free retirement tools. And there's only 3 of them: municipal bonds, Roth IRAs, and cash value insurance contracts. Roth IRAs are very limited on what you can put in. Municipal bonds are dangerous, scary, and don't pay very much. Go to charlietaxfree.com and you can see exactly what I'm talking about. How to use life insurance policies built the right way, built like a police car, souped up. Yes, when they started, they were probably crappy, but after we get done working on them, you now have a police car, not a Crown Victoria. To risk or not risk, should you really be putting money in the stock market? Well, since 2000 to 2018, the stock market has not even beat the safer tools like annuities and life insurance. Annuities and life insurance have paid more interest than the stock market, and that's with a floor where you can't lose a penny. When the market goes down, you can't lose anything. That's called indexed. So more risk, more reward hasn't been true since before 2000, more than 18 years. And the stock market's been going up 3 times longer than it should. It's at like 110 months or something like right now. It only goes up, historically, it goes up an average of 49 months before there's a 27% crash. So we're waiting for the crash. The market's oversold. It's expensive. It hasn't done well in the last 18 years. No. Risk is not worth it. You need to look at the market and say, you know what? It's making 10, 12, 11% versus 6, 7, or 8, and now it's worth the risk. And it hasn't done that for 2 decades. And annuities and life insurance have beat the market, even though we have had an incredible run-up from 2008 until 2018. It still didn't beat the safer tools, so no, risk is not a good idea right now. You can use strategies with no risk and do better. So let's use an example of a 40-year-old. I'm going to do, one example of what it looks like to use one of these insurance contracts, and you're going to see another one, or you're going to see a whole bunch of them in the video. Pretend there's a person, and I don't care if your numbers are $5,000 a year. I don't care if your numbers are $50,000 a month, so that this is $600,000 a year. It does not matter. I don't care if you're 40. We've done this for up to 83-year-olds. It doesn't matter as long as you have, at least 5 years to put money in. Inside of these tools, these be your own banker, bank on yourself, infinite banking, cash flow banking, arbitrage tools, tax-free growth, tax-free retirement. Inside of these tools, the way it works is you put money in. Here's $50,000 a year premium right over here on the left. Over 5 years, that's $250. Say you're just doing real estate deals. This is some extra money. You put it away. There will come a day, and this is why these were created. This is going back to the 80s and 90s. This is not new. The reason your Edward Morgan Lynch guy doesn't show you this is because he wants to sell you mutual funds and charge you ridiculously high fees to gamble with your money in the market, and he tries to hide this kind of stuff from you by bad-mouthing it because it doesn't pay well, and it's not what his company wants him to do. If you fund it, you work till you're 64 and you put just $50,000 a year away. Some people can do that per month. Some people can only do $5,000 a year. It doesn't matter. Whatever you can do, it can be adjusted. All of a sudden, you're going to flip on an income, a tax-free retirement income. You're going to see that in my video, charlietaxfree.com. Tax-free $332,000 a year is the estimated income using growth that's less than what these policies have actually earned. We're using an average compounding of less than the actual historical average. You put in $50,000 a year, end up taking $300,000 a year tax-free out. Let's just do some quick math. You put in a total of 1.25 million, 1.3 million, because there's this extra 50 right here, right? Put in 1.3 million. All right, 1.3 million. You take out 332 for 10 years. There's 4, there's 9. By the time you're 75 years old, you've taken out $3.32 million completely tax-free. We've almost tripled the money already. Every 10 years you can live, you take out another $3.32 million. Nothing compounds money like this. And oh, by the way, Charlie, what happens if I die? Over here, it's life insurance. We didn't want life insurance. We're using it backwards. We're saying give me the smallest amount of life insurance possible just so it's tax-free. I don't even care about that. But just the minimum that has to come along for the ride. If you pass away, your family gets $3 million completely tax-free, or $2 million, or 2.6. Long life, short life, rough life, sick life, next life, doesn't matter what happens in the 5 lives of retirement. This strategy will take care of you. I've got an hour on just this tool at charlietaxfree.com, so I'm not going to cover it too much right now because I want to show you the leveraging piece for those of you that can afford to leverage and wait 15 years. It doesn't matter if you're 60, you can wait till you're 75, and this takes care of the second half of retirement because you're going to need a bunch more money because of inflation. Or if you're in your 40s or 50s, you might have 15 years. And that's fine. But this is the most exciting thing in the entire world of life insurance or cash flow investing, arbitrage, tax-free retirement. The most exciting thing in this entire world exists for people who are under 60 years old. If you're over 60 years old, talk to me. I might be able to get an exception. You're making 100 to 150 a year between the two of you, household. So if you're making 60, your wife's making 60, you're good. Okay, 150 to 100 to 150 per year minimum, and you'll be able to give it 15 years to grow. This particular strategy is much more about retirement planning, not about borrowing against it, using it for down payments. If there's money in your life that you can let sit for a while, and you want to take care of your retirement better than any other strategy on the planet, you can use leverage. Now, what's the most common or easily understandable example of leverage in the entire world? At least our world. Mortgages. Imagine if we didn't have mortgages. Imagine if we lived in homes that we could afford, meaning you could actually pay cash for it. What would that do to the quality of life for most people? I understand you may have paid cash for a home, and you know from what I taught before that I think that's a mistake, that actually hurts you on your taxes and on your compound interest and on your safety, but it does represent quite a stellar accomplishment. You had a lot of money at one time and you were able to buy an entire house. Congratulations. That's not most people. What would happen to the quality of life for most people in this country if we didn't have mortgages and we could only live in homes that we could afford to buy? The quality of life would drop dramatically. Mortgages, the fact that someone will make interest on us so that we can live an incredible lifestyle and pay it off over 30 years, makes a quality of life possible that would never exist without that. It's a good thing. We are serving each other. We are serving the bank by paying interest. They are serving us by allowing us to live an incredible lifestyle that we could never afford. Leverage is good. Partnering with banks is good. On a global scale, it's done incredible things for the world and for your life personally. Guess what? Banks don't care how they make that 4 to 6% as long as it's safe. They do not care if they lend you money on cars, personal loans, mortgages, or your retirement. If it's safe for them, they want the money, and that is such good news for us. Banks will lend you money to fund your retirement. Almost everything I teach, people say that sounds too good to be true. I have a podcast episode called Why Everything I Teach Sounds Too Good to Be True. Of all the things I teach, nothing sounds more too good to be true than this one, and yet it has existed for decades and decades and exists in multiple different options available to you. Banks will lend you money to fund your retirement so you can have a retirement so much better than you could ever afford without the banks. and it's for exactly the same contributions. Basically, you end up with 50 or 100% more retirement income. Let's take a look at what I'm talking about. One example, there's multiple plans. This one's called Kaizen. This particular strategy is called premium finance. It used to be available only to people that were worth $5 million and more, which is probably why a lot of you never heard of it. And it's why I didn't really focus on it, because I didn't work with the ultra wealthy. I worked with regular folks. Now it's available for almost everybody. If you make $100,000, $150,000 as a household and up, this is available to you. If it's not available to you, you just use the old amazing strategy that I showed you, or that 40-year-old put $50,000 a year in, or $5,000 a year, or whatever, make an incredible tax-free retirement. But if you are making enough money and you qualify, you can supercharge your retirement and do incredible things. What these little pigs represent is, what if you could put in $33,500? I don't care what the numbers are. You could do $1 million a year. You could do $13,000 a year. This is just one example. If you put in $13,500 for the first 5 years, the bank will put in another $38,664. They will more than double your premiums. They will lend you money to finance your retirement to create tax-free income. Then, when you no longer fund, by the way, you don't have to stop funding. You could start another bucket and do it every 5 years. Booyah! That's the way to do it. But after 5 years, when you're done, they jump it to $70,000 for another 5 years. If you contribute $167,000, and again, this number is totally customizable, they will put in $546,000 extra dollars. It's like mortgaging your retirement. You're supercharging it. You're getting more than you could afford because they want to earn interest. Period. There's no complications here. They want to lend you money so they can earn interest. So you're putting in $167. The total that's going in between yours and theirs, $706,000 working for you to create tax-free retirement. There's the funding schedule. That's what it looks like. What I want to do is come down here and show you the meat. You can ignore most of these columns. I just want you to understand the basics right now. You're funding $33,000 for 5 years. They're putting in more than you are for the first 5 years, and then $70,000 for the next 5 years. And guess what? The reason I say it needs to wait, you need to be able to wait 15 years, because for the first 15 years, you shouldn't take any money out of it. You should let it cook. And in year 15, the bank is going to pay themselves off out of the policy. There's this huge cash value that's been growing, right? Cash value right here in this column, 62,000, blah, 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 was up to 1.1 million. They paid themselves back all of what they lent you plus interest. That's all they care about, is making this 4.7, 5.1. They don't care how they make it, whether it's on a home, a car, or lending you money for your retirement. What does this do for you? $97,000 a year of tax-free retirement income every year for as long as you can live. Well, how much money did you put in? Well, I don't know. 33,000 times 5. I think they showed us up here what it was. $167,000 you put in total. Again, this is totally adjustable. You could do $13,000 a year. You could do $1 million a year. This is just one example. You put in $167,000 in the first 2 years of retirement. You take out, that's darn close to $200,000, right? Was that $194,000 tax-free? In the first 2 years of retirement, you take out more than you put in, and then every 2 years for the rest of your life. For 5 years of giving them $33,000, you get $97,000 a year tax-free for, what is this, from age 65 to age 90 is what they show in this example. And actually, there's plenty of cash left here. It could just go on forever. What I'm telling you is, if you understand how mortgages allow you to own homes that you could never afford, but it's a total standard, wonderful, beautiful partnership, the same thing exists in the retirement planning world. You can partner with a bank to supercharge your retirement using leverage. And who's able to do this? People that make $100,000 to $150,000 a year as a couple. In the real estate investing world, there's a lot more of those people than there are in the just regular old work a job world. So I help real estate investors all the time set up these policies. There's some very famous real estate investors that set up policies the old way, with another teacher. They bought an insurance policy and they were just funding it. And now I'm showing them how they can supercharge it for the same premiums, get 4 times as many premiums in there for the same cost. Folks, I hope this was helpful for you to look at just these 4 basic ideas. There's not only 4 strategies, there's all kinds of different ways that I can help you and we can partner together. You are a master at real estate, so you do your thing. I'm a master at what to do with the money once it's come in, how to minimize taxes, how to grow it, how to leverage it, how to keep your money working for you and use other people's money. So we looked at down payments. I don't think you should make them. I want you to set up a bank and let the insurance company make your down payments for you on favorable terms. I don't think you should pay off properties and just take taxable rent. I think you should have mortgages on all of your properties and have 2 rents or 2 sources of income, all the interest earned on the money that used to sit inside the home, plus the rent, plus a tax-deductible mortgage expense, because that's good. You get a tax deduction, plus you're paying yourself back principal. I don't think you should put money into the stock market or the bank if you're killing it. If you're investing on terms and you're making $50,000 to $70,000 a deal or whatever it is you're making in your strategy and you don't need it all, I don't think you should throw it in the stock market and cross your fingers and hope that as all the baby boomers retire, the stock market somehow grows the same way it did while they're working. I think you should put it into one of these strategies that grows tax-free so you're ready if taxes go up. And I certainly don't think you should invest in a non-leveraged way where just $1 equals $1. If you can have $1 equal $4 because some bank wants to earn interest, just like the banks and insurance companies are all looking to pay low interest to earn high interest, I think you should do the same thing. Leverage your money, have good debt in your life, because there's 3 types of people in the world. Those who pay interest, that's bad. Those who earn interest, that's good. Those who pay low interest to earn higher interest, which is called arbitrage, and that is great. Folks, if you want some help, you can call my 800 number, 888-285-2268. If you want to talk directly with me or email me and my team, you can email me at charlie@jewettwealth.com. Charlie@renovatingretirement.com probably works as well. You can go to the website, jewettwealth.com, to find information on the podcast, which you notice there at the bottom. There's 113 episodes, probably 60 to 70 hours on all the tips and tricks you need to know in the retirement planning world to protect you from the bad guys and do what's best for you. But get in touch one way or another. Let me and my team know how we can help you, and I hope that this was beneficial to you. Hang in there, keep investing, keep rocking, and here's to your successful retirement.